All right. Hi, everyone. We are live. Welcome to a very special edition of Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I am joined by CNBC's senior markets correspondent, Bob Pisani. And today we're going to be talking about your new book, Bob, Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange, which comes out October 18th. So first of all, congratulations on the book, Bob. I know that is no easy feat, so you must be very excited that we're so close.
2 years of my life, believe me. I don't know how many of you people have written the book. It's quite an undertaking, and most people fail in the execution. It's really hard to write a book coherently from start to finish, and it took about 2 years. But I'm very proud of it, and it sort of summarizes, what I have learned in the last 25 years on the floor and 32 years at CNBC.
Yeah, well, you did a really great job. Bob, your voice definitely shines through in it, so congratulations again. We have a lot of questions to get through today, all about the book. So first of all, can you tell us a little bit about how you came up with the title, Shut Up and Keep Talking?
Yeah, so I was talking to the publisher. I wanted to say something like title, Lessons on Life and Investing from the Floor of the New York Stock Exchange, something like that, but I didn't have a title. The publisher was saying to me, so what do they say to you when you're sitting there waiting to go on the air? We have these are called IFBs, interruptible fullback, and producers talk to you, the wireless. People love talking about the mechanics of the television business. It seems to be fascinating to a lot of people. And I said, well, usually you can say a lot of things, but typically everybody's busy. So the commands usually consist of two phrases. One of them is wrap, which means shut up, and the other is stretch, which means keep talking. So you can hear a lot of things, but basically you hear some variation on shut up and keep talking. And he said, that's the title. That's it. Shut up and keep talking.
Yeah, it's a great title, Bob. So let's go back to the beginning. Take us back to your first day working at the New York Stock Exchange. How did you get to that position? And then how does it look differently today?
It was 1997, the summer. I had been at CNBC for 7 years. I was the stocks correspondent, the real estate correspondent from 90 to 96. And I made the transition because CNBC was getting very serious ratings beginning about 1995. And the reason we were getting ratings was because of the internet. The Netscape IPO in August 95, people were fascinated by this shiny new object called the internet. And we started getting real ratings because people were really interested in investing in internet type stocks. And I wanted to be in on the stock market. So I became what was called on-air stocks correspondent at that time in the summer of 1997. When I got there, there were 4,000 people on the floor. And they did 80% of the volume on the floor in the New York Stock Exchange done. And it's really remarkable about story of technological progress and technological disruption, because there were 4,000 people on the floor that did 80% of the volume in 1997. And now there's probably 200 or so that do 15 to 20% of the volume. The NYSE is still very powerful. It's a big force. It's part of Intercontinental Exchange, but it's a very different, the floor is very different because of the technological disruption, the growth of electronic trading, and also the changes in the pricing structure. Stocks were trading in increments of an eighth in 1996, then in 97, a 16th of a dollar, and then in 2000, they went to pennies, and that changed the dynamics, the profitability of the industry. So I saw a lot of changes, and the book describes some of those changes.
So, Bob, I know that one of your favorite parts of the job is all the interesting people that you get to talk to. And you said that in your 25 years at the stock exchange, thousands of people have come to ring the opening and closing bells. So is there one that stands out for you?
Yeah, I will tell you what it is. In 2005, you hear that? That's the opening to Whole Lotta Love. This is Jimmy Page at the New York Stock Exchange. It's May 2005, and Warner Brothers was, Edgar Bronfman was debuting Warner Brothers Music Group, and he wanted to make a splash, and he showed up to ring the bell with Jimmy Page. And instead of pushing the button, which is what everybody does, Jimmy Page walks up to the podium, onto the podium with that famous Gibson Sunburst guitar and just starts playing. This is the actual recording. And there were 200 guys like me who grew up with Led Zeppelin, all with worn copies of Led Zeppelin too, the vinyl stuff, and Zofo and In Through the Outdoor, that they were hoping Jimmy Page would autograph. And everybody's going nuts. He starts playing, and you can't hear the bell ringing because he's playing a whole lot of Love, and everybody's cheering, and I'm cheering. I'm really excited too because I'm a Led Zeppelin fan. And the tradition is you come down, you ring the bell, and then you come down the stairs and you come onto the floor. Well, most people don't know this, but there's two ways you can go down the stairs. You can go down the stairs after you ring the bell and go through the back door. You make a right, and you can go out onto Broad Street where there could be a limousine waiting for you to go away. Or you make a left and you come onto the floor. So I'm standing there at the bottom of the stairs, and all these traders around me with all these worn vinyl copies of Led Zeppelin albums. And I got a microphone and a cameraman behind me, and I'm waiting to meet Jimmy Page. So the traders want to meet him and all this. And Edgar Bronfman comes down off the stage, comes entering in. I said, "Hello, Edgar, how are you?" "Good, good." "So where's Jimmy?" "He's not coming." Jimmy had gone right down the stairs and gone out of the building. And it had been known for a long time. Jimmy Page, gets a little nervous in crowds, maybe a little agoraphobia, something like that. But everybody was really disappointed that he didn't come down and sort of hang out with us. And we didn't get an interview with him and didn't get. But that was a wonderful moment. And one of the only times I can honestly say nobody heard the bell ringing.
Yeah, that definitely sounds like a memorable one, Bob. So that sounds like a lot of fun. Another, a really great skill that I think you have is you can talk to anyone, but you can also get people to talk to you. So in the book, you tell a story about an interview with Aretha Franklin that you did, and again, how to get people interested in speaking with you. So what did you say to her?
Well, people often ask me, they want to make an impression on people. They want somehow that you want to introduce yourself to someone who you think is important, or you want to make an impression on, and you don't really know what to say to them. And the thing I always say is find the thing that most interests them. And that's how they're going to remember you. So Aretha Franklin came on the floor in December 2008. This was a terrible year. This was the height of the great financial crisis. And the market had not bottomed, even though we didn't know that. But she was there to promote her Christmas album, which she had out. Now, I was fairly sure that this Christmas album, while it was important for the moment, was not that important to her long term. And I got the interview with her. She agreed to come on. And I asked her about the Christmas album. You have to ask about the product they have. But then I said, there's a new movie that just come out, Ray, which is a biopic of Ray, which was a sensation. And it educated people about Ray Charles' contribution and how he created soul music. Soul is a combination of sort of gospel music and pop music. And he created soul. And the biopic shows this. It educates people about how important Ray Charles was. And I turned to her and said, this Ray biopic is a sensation. The kids love it. They didn't understand how important Ray Charles was. You were part of that. How about your biopic? And she said, well, I'm really interested in doing that. We're really interested in talking about it. I'm really trying to get something together on that. Well, it took many, many years. Eventually one did come out, but she really brightened up the minute I asked about that. And after that, her manager, the interview was over, her manager came over and said, I don't know what you were saying to her, but she seemed very interesting. And, she's very reserved in these interviews. And she was famously reserved in interviews. And you asked, whatever you asked her was the right thing. So the point was this. She was there to talk about her album that she just had out, but she really was interested in her legacy. And the biopic was a way to get out the info on her legacy. And she already knew about the Ray biopic. So I asked the question that most interested her. So there's what I would tell people. If you want to meet somebody that's important, and if your CEO or some famous person, find what motivates them or what interests them. You might say, I heard you were working at that charity event. I love that charity. Something that's going to make that person say, aha, I remember you next time. Now, Aretha Franklin and I never met again, but the point was I got that one question that I knew would motivate her to say something interesting.
Yeah, that's definitely great advice that people can apply to many different situations. So Bob, I want to get your secrets on career longevity. You've been stocks correspondent for over 25 years. And in the book, you tell a story about meeting Barry Manilow. So can you tell us a little bit about that?
This is one of the great things. Like I always tell people, they ask me what it's like to work at the New York Stock Exchange. And I said, what would it be like for you to meet all your heroes, every rock star or politician, or kings or queens or something like that, that you'd want to meet? Well, it's been 25 years. The opening and closing bell, that's almost 10,000 bell ringings. Think about that. I've met almost all my heroes, everybody you want to meet. Motley Crue I met the Prime Minister of Japan last week, 2 weeks ago. I mean, imagine that. That's quite an honor to say hello. And, and a lot of times these aren't even formal interviews. You've got 2 or 3, 4, or 5 minutes alone with somebody. But imagine, would you want 5 minutes alone with anybody you want? I've done that. Almost everybody I've wanted to ever meet. So one day Barry Manilow came on for, it was 2014, 15, something like that, a few years ago. And he was promoting a new album. We did an interview with him. I didn't do it. My colleague, Bill Griffith, did it. And he walks off and he's just standing there alone. Now, I'm not a Barry Manilow fan. I'm a Led Zeppelin fan. So I don't care that much about Barry Manilow. But he was standing there. I'd say hello. So I walked up to him and he was literally just alone. And I said, Mr. Manilow, just 2 quick questions. You really did write the State Farm jingle, right? Like a good neighbor, State Farm is there. And I'd known that. And I said, and he looked at me and said, yeah, I wrote it. I sold it for $500. I was a jingle writer. I'm proud of that one. And there were a few other ones. He did a Band-Aid commercial that was very famous. He said, yeah, that's what I did before I became a songwriter. I was a jingle writer. I said, there's something else that's really amazing to me. He had just sold out like Nassau Coliseum, 15,000 people. Now, he hadn't had a lot of hits in a long time. And I said, this is really quite impressive. You've got a very loyal fan base. Wait, how do you account for that they're still with you? And he said, he gave a very thoughtful answer. He said, I was quite famous in the 70s. I had a lot of hits. I kept doing what I really loved doing. I kept producing albums. I may not have had as many hits, but I kept doing what I loved. I stopped worrying about trying to make hits. I just kept doing what I really loved to do. And I got a new album out. I've done different kinds of genres of music. I'm doing things that make me happy. And he said, you stay at this long enough, all of a sudden somebody starts, saying you're a legend. And then people notice you again, all over again. The subtext of what he was saying to me, I thought was very profound, because what he was saying is a lot of people have careers where they have some success early in life, and then they have a middle part of the career where they get kind of bored, or they decide they should do something else and they go and leave. But a lot of people just kind of stay with what they're doing, either because they really love it, or, financially they need to stay with it. And that happened to me, after 9/11, after the dot-com bust, was a sort of middle part of my career in the mid-2000s. And a lot of my peers left. They went to do other things. I decided to stay because I love the stock market. I love CNBC. I love the New York Stock Exchange. I love hanging out with traders at night, going out and having a drink. I loved all of it. And I just decided to keep doing what I loved. That's essentially what Manilow was saying. And it's that middle part that gets difficult. And finally, if you stick with it long enough, you become very well known. And that happened to me. It's like Manilow, you're inch wide, mile deep. Suddenly, you're very well known for a little part of the world. Barry Manilow is a big star, but in my case, this little part of the world is called the stock market. So that really resonated with me. I thought that was very profound observation. And I ended up having a lot of respect for the guy. And I went out and read one of one of the books about him. And of course, he gets made fun of a lot, but I thought he was very wise. And that's one of those like odd things, like who would have thought anything would have come out of that, just saying hello to him. And that's part of the fun of being down there. Every once in a while, somebody says something to you like, wow, that's very interesting. And you remember it. So that's one of many stories that are in the book.
Yeah, you have a lot of great stories with people that you met in the book. You also have some great pictures too in the middle, which was fun to see you and meeting all these different people over the years.
Yes, Harriman was very kind to put some color pictures of me and one with Barry Manilow. But I'll tell you, somebody who really stuck in my mind was Muhammad Ali. in 1999. I mean, probably the greatest month of my life. Walter Cronkite was there. All the famous baseball players, Jack Welch, the head of General Electric, and Muhammad Ali. And I went up to Muhammad Ali and said hello to him. Now, I'm 6 feet. I'm not small. Muhammad Ali is 6'3", but 6'3", much more than 3 inches would imply. He had broad shoulders. And when he shook my hand, his hand around my hand. I mean, he was very imposing. Even in 99, he was greatly diminished. But I could see, I mean, my heavens, I wouldn't want to go up against him in 1965 or something. He was very imposing and impressive person and very serene. You know, it was only, and again, it was all things. I literally walked with him for 2 minutes. I got a picture. It's in the book, but the very short encounters, just chatting briefly, not necessarily terribly significant, but left a very big impression on me.
Yeah, for sure. So, Bob, you spend a good portion of the book talking about why people are so bad at forecasting the future. Not just picking stocks, but even the Fed isn't really very good at predicting the future. So why is everyone so bad at forecasting?
Yeah, there's a problem with the future. In fact, if you think about this, why is everybody so bad at it? I mean, think about what goes on with stock picking. Amateur stock pickers are terrible at predicting the future, right? Okay, we know that. But professional stock pickers, Katie, are terrible at it too. And economic forecasters are bad at predicting the future of economics. The Federal Reserve itself has a terrible track record of predicting something as simple as the GDP of the United States 1 year from now. If you've been doing this for a while, you got to ask yourself, what the hell is going on? Why is everybody so bad? Not just amateurs. Why are professionals so bad? Why? And it turns out there is a lot of problems with predicting the future. That is not just about the stock market, but it's about predicting anything, even the weather. And the first problem, this is about the stock market, is that predictions are riddled with biases and noise that limit the quality of the predictions. So, for example, you could have overconfidence in certain aspects of your data. That's just wrong. And we can go through the various biases, but there's a lot of these. And it turns out it infects the ability to get an accurate forecast. The other problem is a bigger problem. We don't have complete information on what's going to happen in the future. So it's unpredictable, the future, and it can affect outcomes. Think about this. Think about, I'm an analyst, and my job, it's December. My job is to predict what the earnings are going to be of this company 1 year from now. That sounds simple. In fact, it's almost impossible. It's impossible because there are so many millions of different variables that go into determining what that stock price will be a year from now. And think about it. So on the macro level, you may have the economy facing new shocks. You could have a disruption to the company like we saw. You could have a new competitor. You could have the CEO fall ill. Think about the millions of things that can happen. And that's not even considering a black swan event like COVID. Who would have thought of that? Or Russia invades Ukraine. Who had that in their playbook? Nobody. So it turns out that this is really, really difficult to figure out. And when you understand that, you become a lot more humble. You stop saying, retail investors can't pick stocks. Professional investors can't pick stocks. Economists are terrible at predicting the future. The Federal Reserve is terrible at predicting the future. You stop being so cynical and saying, why are they all dummies? And you start realizing how difficult this is. Another observation is this gets much more difficult the further out you go. So success rates get higher when the forecast is shorter term than longer term. But just knowing this fact, how difficult the future is, makes you a lot more humble. There's a guy who wrote a great book about this I highly recommend, Philip Tetlock, called Super Forecasting. He's at the University of Pennsylvania. He thought about all this stuff in much greater detail than I'm giving you and came to the same conclusions. And noticed that it was possible to train people to be better forecasters, but it didn't have anything to do with how smart you were or how much access to data you had, although that was important. It had to do with attitude. Tetlock noticed that certain people kind of fall into two groups of people. One are hedgehogs. Hedgehogs are people who have an ideology, one big idea, and they tend to impose this idea on everything around them. Other groups are foxes, he called them, and foxes tend to be very open-minded. They're not terribly ideological. They change their information as time goes on. He found that foxes are generally better at forecasting. They're more open. And so he actually started a project called the Good Judgment Project to try to work out this and see if you could make better forecasters. And this is not just stock market. This is general forecasting. And it's really quite remarkable. That it doesn't mean that the future is not unknowable. It is. But you can probably get better at this, but not a lot of people pay attention to it. So the bottom line, Katie, is I've gotten a lot more humble about, being cynical about analysts and, stock pickers. It's just really difficult to do.
Yeah, for sure. So we know that the future is hard to forecast. Let's kind of drill down now on what that means for stock picking. Why do most stock pickers tend to underperform the overall stock market? And is that getting worse?
Yeah, it is. They underperform, and the numbers are astonishing. Every year, S&P puts out a report. It's called the SPIVA report, SPIVA, about the performance of active stock pickers against a passive index like the S&P 500, and that's terrible. This year, for the first 6 months, they're doing a little bit better. 51% of big cap stock managers underperform. 51% underperform. Believe it or not, this is fantastic. This is a great record. But over time, the numbers are terrible. After 10 years, 90% of all large cap active fund managers underperform their benchmark. 90% underperform. And they take into account things like cost, how much they're charging, and survivorship bias. A lot of funds go under in a few years, and they're terrible, and people get trapped in them, and S&P accounts for that. So why is this happening? And besides the unknowability factor that I talked about, it turns out like professional stock pickers are not stupid. It's actually just the opposite. There's too many of them. They compete against each other. Many, many years ago, most of the stock market was just average retail investors. But in the last 50 years, there's been the rise of professional stock pickers, institutional managers, pension fund managers. And these people tend to have access to the same amount of information as everybody. They do not have information advantages. And because of that, because the market is largely professional now, people who have access to the same information, there's very little outperformance ability that you can get out of this. Its alpha is very limited these days. And if that's really what you have to know, how difficult. It's not because they're stupid, the world are idiots. They're not. They're all really good. They're just all competing against each other, and they don't necessarily have any information advantages. So when you understand that, you become, again, a lot more humble about the willingness of trying to, necessarily pick stocks. And it leads to some obvious conclusions, which is that people ought to be very careful about active stock trading. I mean, trading a lot. This tends to introduce a lot of mistakes, and most people would be better off trading a lot less. And, I make it very clear my bias here. I'm a passive investor and index kind of investor because I think for most people, the best thing for you to do is find a level of ownership in the stock market that you're comfortable with and stick with it. Do not succumb to emotion and suddenly decide you want to trade your way out. You'll probably make a mistake. Market timing doesn't generally work. You have to be right going in and going out. So long-term investing and passive investing, which I talk about, is the way I personally feel about it. Now, what does that mean about active investing? Does that mean I'm against it? Does that mean I'm against doing things? No, I'm not. Even Jack Bogle, who founded Vanguard, the man who had the biggest influence on me, recognized that people don't always want to just sit there and stay with the market. There are people who want to bet on the Giants game, and there's people who want to bet on Intel and Microsoft, and not just sit there and play with the S&P 500. And Bogle knew that, and we all know that. So nobody is standing around saying, "Oh, I'm an ideological, I'm an ideologue. I don't believe anyone should be doing any of this. They should be just in passive index funds." No, I know that. Bogle knew it. And Bogle was very involved in the beginning of Vanguard with developing actively managed funds. There's funds still there that he founded, Capital Opportunities Fund, actively managed by very, very good people. what he was against was high-priced funds. And he noted that the few people who were able to outperform, their performances were often bad because they charged too much. The fees ate into the alpha. So whatever you do in active management, keep it low cost. That was Bogle's central insight. And he was never against active management per se. He was against high-priced active management. And so if you have that itch, Bogle called it scratching the itch, keep it in low cost, no matter what you do. And just remember, Bogle had a famous line, don't just do something, stand there. Before you make quick emotional decisions, stop and consider, because you're probably, if you have a real plan, you're probably better off just sticking to the plan.
Well, Bob, I think that's a great segue to our next topic. So you devote a part of the book to behavioral economics. So what is behavioral economics and why is it so important for investors?
Well, this is a very important part to understand. Robert Shiller, who wrote Irrational Exuberance, a book in 2000, had a big influence on me, noticed something years ago. He was sort of one of the grandfathers of behavioral economics. He noticed that if the stock market is supposed to be reflect a certain amount of fundamental investing. So what do you get when you buy stocks? You're supposed to get expectations of a dividend and maybe some expectations of future stream of earnings. And he said, well, based on that, there should be a certain volatility level in the stock market. And he noticed, and this was decades ago when he did this, that the volatility of the stock market is much higher than you would expect if people acted rationally on fundamental analysis, dividends, future stream of earnings. Why? And he said, well, his conclusion was there's a certain element of irrationality that's in the market that accounts for the higher volatility. That was sort of the birth of behavioral economics, practically. So behavioral economics attempts to show people how people really act and not how they're supposed to act. People don't always buy low and sell high. They do the opposite. They buy high and sell low. Why? Well, there's a whole bunch of things that happen. There are primarily biases that people have in their head that cause them to do stupid things. There are emotional biases, for example. They're based on feelings. Then there's cognitive biases. People don't think right. So here's an emotional bias. Here's a famous emotional bias. It's called loss aversion. People fear a loss more than the expectations of it. This is sort of built into our rationing. People are afraid of a loss more than the expectation of a gain. So they'll protect themselves. So for example, what they do, they might hold on to a losing stock for a long time because they fear that loss. Here's another one. People are overconfident. They come to believe that they're infallible and they can keep going on forever. Then there's these mental errors that people make all the time. There's confirmation biases. People think about this. They select information that only supports their point of view, and they don't want to listen to anybody else's point of view. Why? That's a real serious bias when you're trying to make a decision. For example, I'm buying a stock. I'm only buying stuff that, I think is a growth stock, or, I'd only believe in the following things. Why? So there's all these biases that basically infect people's thinking. And I'll just wrap this up. There's more on this in the book, but number one, it's what happened with behavioral finance. When it became really big in the 2000s, it gave a whole boost to the passive investing crowd, because people said, hey, if everybody's biased, including the people picking stocks and the professionals, why don't I just go with the market? That'll eliminate a lot of the biases. You see, that helped passive investing. The other is this whole, is stocks priced right or not? Look, people recognize the markets may not be perfectly efficient, but it's efficient enough. There's definitely some irrational component sometimes, and particularly in certain stocks, that happen, but don't knock yourself worrying about it. And the final thing I would say is, can you make people think more rationally? And I think you can, but I don't expect too much. And I'll tell you why. I think that, first off, there's an enormous amount of financial illiteracy, stupidity, bad thinking out there. Despite everybody's best efforts, CNBC and websites and everybody out there, there's still a lot of dumb financial illiterates out there. And second is, even people who should know better continue to make dumb mistakes, because overriding this brain's idea of thinking first or acting first and thinking later, rather, is really hard. And I did this too. I've made several dumb investing mistakes, and I actually chronicle them in the book.
Yeah, and I think that's one of the really interesting parts of the book, Bob, is how much you get into your own personal holdings and personal mistakes that you've made along the way. So why don't we talk about that? What are the stocks and bonds and mutual funds that you own? And then if you want to, we can
Yeah,
get into any investing
well,
blunders.
it's amazing to me that nobody ever asks me what I own. I've been doing this for more than 30 years. And when I see people on the street, they'll usually say, "What do you think about the stock market?" Which means they come to me the next 3 to 6 months, short term. Some people want to know about how TV works, like what do I think of this person or that person, or what do they say in your ear, or the mechanics of television. But nobody ever asks. It's amazing to me. Maybe it's people think it's private or embarrassing, but to me, that's kind of an important question. So I actually wrote a chapter describing my whole investment journey and what I own. And a lot of it is based on what happened in the early 90s and my relationship with Bogle and Vanguard. I opened a Vanguard account for my wife in the 1990s. But originally, I'll give you the two mistakes I made. And there's more on this in the book. When I got the 401k in the early 90s, I'm not allowed to own individual stocks or bonds. We're restricted, but I can own mutual funds and I can own ETFs. And we can own the stock of the company that owns us, which at that time was General Electric. They owned NBC. The first thing I did was buy enormous amount of money into 401k, into GE stock. And by 1999, 50% of my portfolio, 401k, was in General Electric stock. Now, this is a very serious error. There's no rule on this, but certainly you should not own more than 10% of your 401k in your company stock. It's too risky. It's that simple. And yet I did. And when you look at why, go back to what I told you about behavioral economics and the biases. I had overconfidence, not in myself, but in the ability of the CEO of General Electric, Jack Welch, to manage his way out of anything. It's hard to describe how important Jack Welch was to my generation. He was a corporate god, the most important person, CEO in America. And I knew him and I believed in him. And I had a tremendous amount of, in retrospect, overconfidence. Mistake number one, a bias. Number two, I held on to the stock for many years out of misplaced loyalty to General Electric and to Jack, even after Jack retired in 2000. And he had a new CEO come in. And I sold it several years later. And I figured out loosely in my head that it was a loss after 15 years. And I saw Jack Welch at a party in 2010. And I said, Jack, please don't be mad at me or start yelling at me, but I couldn't take it. I sold the stock, everything. I have nothing. And he looked at me and put his hand on my shoulder and he said, Bob, don't worry about it. I completely understand. Now, you make sure you tell everybody I never sold. And he was very emphatic. He said, tell everyone I never sold. Now, Katie, I have no idea what Bob Wright's position, what Jack Welch's position was. I was talking to Jack Welch, I'm sorry, at a party. But Jack, I like to think, was the kind of guy that knew exactly when to cut his losses. And I did. So there's two biases I had. Too much money in your own company stock, staying too long in an investment. And again, I go back to what the mental thinking, and it wasn't like I didn't know. I did know. That's what's disturbing about it. And that's what these mental biases can do to you. You can even be aware of it and you still do it. And that was a painful part. As for what I own, it's in the book. People are always disappointed to hear that my biggest holding is an S&P 500 fund. That's a core holding. And I have some mid-cap index. I have a small cap value fund. I have an international fund. And people I tell people, this is what I own. And they look at me kind of disappointed, like saying, that's it? You're the senior stocks correspondent and markets correspondent, and this is what you own? You own this kind of boring index stuff. And I said, well, yeah, that's the whole point of this game here. And then they want to say, oh, well, tell us what you really own, like the really hidden stuff, like the Illuminati stuff, like you own leverage inverse, Malaysian bonds or something. And I always look at them and say, no, I don't. Sorry. There is no, and even if I wasn't restricted, I still wouldn't own any weird, bizarre stuff. I might own some preferred stock maybe, but no, it's so, it's sorry, it's not terribly exciting, but in some cases, in most cases, boring can be good.
Yeah, I think our Market Matters listeners and viewers will definitely know that we've talked about this before. In the long run, boring can be good when it comes to investing. So And Bob, I just wanted to wrap things up. You know, you've been stocks correspondent for 25 years. What have you learned about investing over that time?
Well, I'd say that if you want to just learn something very simple, sorry, I just remember this. This was from Bogle. I mean, 25 years ago, he kept pounding this into my head. There's 4 components to investing: risk, cost, and at time. So you return, risk, cost, and time. RRCT. So return is just how much you want to earn, how much you expect to earn realistically. The risk is how much can you afford to lose without destroying your ego or your pocketbook. Cost is think seriously about what you're really paying for whatever you're investing in. That is really important because the difference between 1% a year cost and 2% over 30 years is a lot. Bogle showed you that. And finally, time. Think about the length of your investment horizon. People don't think about this, but if you start investing at 25 and you live to 85, that's 60 years of investing. You can do a lot in 60 years. It's about staying in the game that time and having the mental discipline to do that.
Well, that's great advice and just a little preview of what you can get in Bob's book. Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange comes out October 18th, so that's very soon. Thanks for answering all of our questions, Bob.
And it's up on Amazon, those of you who want to slog through 450 pages. It's the book business is a crazy business. It doesn't make a lot of sense economically, but it's a good feeling to, you know, summarize what you think you've learned. It's not easy to do it, and I'm proud I made the effort.
Well, you did it very well, and I hope everyone takes a look at it, and I think people can really learn a lot from the book. So thanks for being with us, Bob, and we'll talk again soon.
Thanks, Katie. Thanks, everybody. Great questions, as always.
Yeah, thanks, everyone.